We want to thank you again for tuning in to our Retirement Education Center YouTube channel, where on this channel, we believe in providing you unbiased advice to help you maximize all of your retirement income. Now, on our channel, of course, we do not believe in providing you any silver bullet strategies or glorifying any type of one product. But what we do believe in are holistic concepts that would help you retire with confidence. So today, the question that we're going to be discussing for our lesson is what or which financial product is best for you. Now, I understand as an advisor that consumers are constantly bombarded, Andrea, with ads about invest here, invest in this, do not invest in that. And it can become so overwhelming and it can become very confusing for individuals to understand what product choice is going to be the best for them. But today, what I hope to accomplish is to give you the most common type of products that you're going to be faced with and let you know the pros and cons of each one. And in doing so, perhaps you will be more educated and better equipped to choose the right financial product for you. So stay locked in. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea Graves, Director of Operations at the Retirement Education Center. And we want to thank you for tuning in to our Retirement Education Concepts videos. These videos were created to help to make the difficult and confusing retirement process simple.
Yeah, absolutely, Andrew, because with so many retirement strategies out there, so many retirement concepts, and of course, so many retirement products, it can become very difficult for consumers to try to digest it all. That's why we're so fortunate that we're able to work with a team of expert advisors to help us build a financial roadmap that will let our clients know when, where, and how they can reach their retirement goals.
For additional concepts on how to maximize your retirement, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos. Carson, getting people to save money is hard enough, but trying to help them understand where to save is even more of a challenge. So how do you help your clients with that?
Well, Andrew, you know what? It is hard for people to save money if they decide to go at it alone. So how I help my clients, Andrew, is just simply being there for them as a professional financial advisor and helping them make wiser choices when it comes to the many financial products that they may be faced with by creating a retirement plan that's going to incorporate their risk tolerance and their short and long-term goals. And so if you're able to do that, work with a qualified professional, the choice of where to save and how to save will not be difficult. But for those of us who want to maybe do it ourselves, maybe this video will at least shed some light on what the common products that you're probably going to be faced with when it comes to your retirement savings. And so that's what we're going to be discussing today. But before we do that, there are two rules to retirement income that we like to give you. And Andrew, what are those two rules?
Well, rule number 1 is to never run out of money, and rule number 2 is to never forget rule number 1.
Okay, so let's go ahead and talk about some of the most common financial products that you're probably going to be faced with when it comes to saving your hard-earned money. So what I'm going to go ahead and do here now is just simply share my screen with you so you can get the full concept of what products are available to you and some of the pros and cons with each product. So before I do anything with my clients, I'm going to always want to find out what their risk tolerance is. And this is going to be the best indication of how you can really determine what type of financial product is going to be more suitable for you or not. So let's start here on the left side of the screen here. If you're looking at it, you can see that over here, we're going to start with the highest possible growth, but the highest possible loss here. In this category, you're going to be looking at individual stocks, no doubt. Now, individual stocks can be very, very rewarding when they pay off, but they can also be very, very debilitating when they don't pay off and they end up going down to half its value or even zero when you're in this category. So yes, you have the most potential for gains with individual stocks, but you have to be aware that you're going to have also the highest potential for loss. As you continue to go down the risk scale to try to mitigate risk, the next thing that you may want to start looking at is really mutual funds or ETFs as well. In this category, now we have a conglomerate of stocks, right? Or a conglomerate of industries to help mitigate risk. So we may have some uncorrelated assets in this particular category. Yes, your gains are still very high, and then your losses are going to still be there, but they're going to be mitigated from individual stocks. Then as we move on down the risk scale, you may also be faced with a product known as a variable annuity. Now, a variable annuity is going to behave much like mutual funds. You're still going to have the ability to have gains, and you're going to be able to invest in sub accounts where you can invest in mutual funds, and losses are still going to be there, but it can be mitigated. You can add some bells and whistles to help mitigate that. But this type of product is going to be very, very expensive, so you're going to want to make sure you get the right details about a product like this here from your professional advisor. As we continue down the risk scale, you can certainly help mitigate some risk factors by implementing bonds. Now, bonds have absolutely taken a huge beating this year. Bonds are down 15% year to date. But with that being said, there are ways to look at, U.S. Treasury bonds or inflation bonds that can actually help you mitigate risk within your portfolio. There's still room for gains, and your losses are, of course, going to be more mitigated. Now, as we cross over the risk scale, we're going to enter to things that are not going to allow you to lose money. This is what's really, really important to help mitigate risk in your portfolio in a down market. So, of course, cash is something that you can have money sitting on the sidelines in your bank account. With cash, it does come with its own risk factor, and that's inflation, right? Your purchasing power is going to be eroded when it's left into cash. So you do have to have a respectable amount there to make sure that you can touch it when you need something that's very quick. But just note that you do not want to have too much money sitting in cash, because you're not going to get rewarded for it in that manner. As we continue to move down the balancing beam here of trying to find out how we can get more returns but absolutely not incur risk, then CDs may also be another thing that you want to look at. Now, CDs may be paying a little bit higher now because they continue to increase interest rates. But with that being said, you're going to have more returns from CDs than you would in cash, and you won't have any risk of loss. And these items are FDIC insured if you get them from your local bank or a bank institution. So you want to make sure that, if you're looking at these items, yes, you're going to be mitigating risk, but your purchasing power is going to be also a factor, because you're not going to see the hyper returns that you would see on this side of the equation. But as we try to now start to increase our growth, but yet still not have the exposure to losses, a fixed annuity is going to be another product that no doubt at some point in your retirement you're going to be faced with. And fixed annuities they more or less mimic CDs, except with one factor: they can give you much higher returns than what a CD is going to be offering you. A fixed annuity may have 3 to 4 times the guaranteed rate that a CD is going to offer you. One of the things to note about a fixed annuity that is not FDIC insured, but they are insured by the insurance company and the state that you're in, up to what they call a state guarantee amount. In the state of Texas, where we are, that amount is $250,000 per policy. And so our clients who are actually in these products, they can feel relatively safe if, one, they pick an insurance company that has high ratings, and of course we also have that state guarantee backing an annuity. So that's one of the things that you might be faced with, and you want to make sure that you understand where it's going to fit in your overall risk tolerance and your financial goals. And last but not least, a product that you're certainly going to see more so now than ever is an index annuity, a fixed index annuity. Here you can see growth is going to be more so than these other safe products that you're going to be utilizing. But a fixed index annuity is very, very complicated, everyone. So you have to make sure that someone is not going to sell you one, but place it in your portfolio appropriately in order to help mitigate the risk that you may have along this balancing beam. Now, fixed index annuity is going to behave more like a fixed annuity and a variable annuity. So it's going to be almost like a combination between those two. One big difference with an index annuity versus a variable annuity is that you have no risk of loss. That is the key component here, but yet you still have the ability to have growth within the market, because you can base this annuity off of like the S&P 500, maybe the Barclays, and many, many, many other indexes that you can actually utilize when it comes to a fixed annuity. So as you can see here on the screen, hopefully this gives you some insight into some of the products that you're going to be faced with within your retirement years, and also allow you to understand what product is going to be best for you. The moral of the story is to make sure that you don't focus on any one particular product. you have an advisor who can look at your risk tolerance and let you know what percentage of any of these products you may want to have in your retirement savings portfolio plan.
So Carson, that should make it really easy for people to understand what financial products they should consider. So thank you for your insight on that topic, and thank you for watching. And if you felt this information was beneficial for you, please like this video and share with others.
So I really do hope that the information that we share with you today will give you better insight on which financial product may be more beneficial for you. Please note that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for a fiduciary financial advisor to help you with these types of complex financial matters, we highly recommend that you utilize any of our links in our description below and go ahead and schedule a no obligation, free 1-hour consultation with us today.
For more information on this topic or any of the other topics that we've shared in our other videos, feel free to reach out to our office or leave any questions or comments in the section below. After this video, please check out our other videos that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.